And from bank failures to rising rates and a looming recession, it's been a whirlwind of commotion thus far in 2023. Here to help shed some light on the potential portfolio moves as investors navigate a slew of market risks, we have PIMCO Managing Director and Portfolio Manager Sonali Pier. Sonali, we've seen the shorter-term bond yields movements in the last few days, especially given the banking crisis pressure, and we've seen on the regional banks. I'll pose this question to you. Do you think that we have seen the last of the woes for the regional banking sector?
You know, this has been a really difficult time as rates have risen quite steeply and quickly. And, you know, what we're seeing is really a digestion of that move. And often these types of moves take time. And so, you know, while it may not, I would say that while the Fed is now likely to pause after yesterday's rate hike, we are still in a period of adjusting to the higher level of rates. And that's essentially what's plaguing these regional banks. But overall, I would reiterate that, you know, this is very different than the great financial crisis, especially as, you know, regional banks have smaller asset bases. And even with respect to the investment grade corporate bond market, they make up about 1.8%.
Yeah, I mean, and just looking at also the aspect of outflows, deposit outflows, and I mean, I'm just taking a look at some of the Treasury yields right now. Looking at the 3-month bill, you're looking at a yield of 5.2%. So why would anyone want to keep their money in a savings account if they can go to the Treasury, to U.S. Treasury, and just buy some bonds there with high yields?
That is part of the difficulty in today's environment. It's not necessarily just concern around some of these banks, but it's also that you know, you can get a much better yield by investing. You know, it is certainly the case, even in a low duration product such as the one you mentioned, that, you know, there's real income that you can generate. Yeah, and, you know, that's part of what our discussion internally around bonds are back. You know, it's hard to ignore that level of yield and income, even with some potential for volatility ahead that can be generated, especially from fixed income products today.
So where should investors be positioning when it comes to bonds?
Thank you. You know, I would say that, you know, a diversified opportunity set in fixed income and high quality credit can be very attractive, especially for a longer term hold, given low potential for default loss and decent income today, and really realizing that in today's environment, with while there could be some spread volatility ahead, we still see potential for positive expected returns for the year.
And as far as Fed Chair Jerome Powell yesterday and the Fed raising rates to 25 basis points, what do you see ahead? What do you think that the Fed may do in the future? I mean, it does seem like that the rate hikes are over, but what do you think?
Yeah, I would just, you know, to thread the needle, I would just highlight that a pause is not necessarily the same as stopping. I think they really built in some optionality with a statement yesterday, really highlighting that, okay, we've done 25 basis points. We've removed that. We think that there would be some rate hikes ahead, and really kind of built themselves the chance to, you know, be data dependent and continue to tackle inflation. Although, you know, while inflation's been sticky, so has employment. And so they still have some room if needed. But at the same time, they're clearly looking at some of the stress in the regional banks and being more cautious with the outlook in terms of timing of next moves.
Thank you so much, PIMCO Portfolio Manager Sonali Pier. Thanks.